lot of companies reported better than expected earnings in the first quarter. They gave us better than expected guidance in the first quarter, and that's really kind of what led to this rally that you had that started really in March. And then we got into April, earnings started coming in better than expected, and the market really just kind of took off here from that point. But now the problem is, going into the second quarter, everybody's very exuberant about this. Okay, here's what you need to know before the bell. The markets are looking forward here, and as we talked about before, we are looking for this bit of this quarter end rebalancing as we get ready for the beginning of that second quarter. But the bigger risk to be paying attention to right now, again, also besides this earnings outlook that we're about to get into, but inflation data is something that we need to be looking at very closely. We're now starting to get past these big year-over-year comparisons where the potential for much lower rates of inflation may start to ebb here a bit, and we might actually start seeing a little bit of an uptick in inflation. Of course, the Federal Reserve has been talking about potentially hiking rates again in the month of July, and that's one of the risks here. While July tends to be a little bit stronger month, considering summer months tend to be weaker overall, one of the things that we're going to have to deal with in the month of July is potentially another rate hike from the Federal Reserve. And this will potentially come into play if we start to see inflation showing signs of potentially re-accelerating. This is one of the big risks to the markets overall, and something that the market has not been pricing in. So ever since this rally from the October lows, this has all been predicated primarily on this idea that inflation's falling back towards 2%. The Fed will stop hiking rates, and they will potentially start cutting rates sooner than later. However, the risk to the markets at this point is a re-acceleration of inflation that leads the Fed to remain more aggressive. And again, when we start talking specifically about technology stocks, and you can function this on the function of the triple Qs, which part of the NASDAQ, primarily weighted technology stocks. These stocks have had a huge run, and these stocks are primarily driven by this idea of lower interest rates and lower inflation, because these companies in the NASDAQ are what we call long duration assets. They depend on lower inflation, lower interest rate environments, because they are primarily predicated, the movement of these is primarily predicated on earnings growth over time and higher rates of earnings growth. So they need an environment that is friendly to create earnings growth. In other words, they need they need time in order to meet those earnings growth expectations. Again, investors are overpaying for earnings, so we need time. That's why it's a long duration asset. We need time for those earnings to catch up with expectations. The problem for the NASDAQ is going to be a more aggressive Fed. If we start to see inflation picking back up, that's going to impact these long duration assets negatively. So that'll be the one thing to be paying attention to. But again, as you start to look forward into the month of July, pay attention to what happens next with the Federal Reserve, because that should be a key to what happens with the NASDAQ. I'm your host, Lance Roberts, and that's what you need to know before the bell.